This is Scott Becker with the Becker Private Equity Podcast. We're thrilled today to be joined by regular guest Matt Wolf, a brilliant leader at RSM. Matt, it's been a heck of a week in the markets as there's some thoughts that inflation is actually softening and that the Fed will stop raising rates. There's still some uncertainty about it, but there's been a lot of positivity based on that perspective. What's your sense? How's the private equity community looking at this? Do things feel like they're starting to loosen back up a little bit? What's your sense of what's going on?
Yeah, great question, Scott. And I think, we got the CPI report, which was fairly in line with consensus estimates, which is a good thing, right? I think the mismatch that we're seeing, particularly in some of the public market asset classes, is around investors who think that because inflation is slowing, that it means the Federal Reserve will cut rates soon. Our estimate, our forecast is likely to begin cuts perhaps beginning in the middle of 2024. Might be in for a series of rate cuts to the tune of 100, maybe 125 basis points. But that's not going to start anytime soon. It's not going to go back to zero. And in the interim, we might see a soft landing. It's probably the likely outcome, which I think will be good for everyone. In terms of private equity, I think right now there's just a lot of portfolio management going on, right? We've seen fundraising slow down. Funds are not hitting their fundraising targets, and we are seeing a lot of maybe might categorize as motivated sales of portfolio companies as private equity fund managers and deal partners, operating partners, as they sort of work through this portfolio management exercise of exiting businesses that will no longer probably generate the return that they had hoped because the multiple arbitrage play really no longer exists, at least not to the extent that they had planned on. Trying to exit those businesses, clean up the portfolio, and then deploy what capital is available to go into new assets, some of which they are of a quality they wouldn't have looked at 2 years ago. But in the environment going forward, we're going to have to, buy some ugly babies and put some blood, sweat, and tears into them to turn them into real companies and make our returns that way.
I mean, absolutely fascinating, right? I mean, just fascinating to see that happening. People trying to exit some of these portfolio companies that have been holding on to for a long time. People having a little harder time fundraising, and then people trying to figure out the next steps on deploying assets. I mean, I'm seeing in some of the funds that we're invested in, starting to see some capital calls again, starting to see some movement, starting to see some of that. But it is few and far between. It's not coming nearly as fast as I would have expected when initially committed to a number of different fund families and so forth. But it's fascinating to watch. But I think your point on some people ready to take their lumps, as long as their colleagues are taking their lumps too, it is fine, because then they feel like they can do that and not be judged so badly in the fundraising environment.
Absolutely. They know I like that, take their lumps. I mean, they're going to have to. And I think, to some degree too, what's been going on in the public equity markets, and we'll see how the S&P ends the year. But, that also can provide a little bit of cover as well. The benchmarks and the benchmark performances. But, ultimately we're seeing, again, fundraising environment is tough. Investors still need to put money to play, but they're starting to favor private credit a little bit more, starting to favor maybe treasuries a little bit more, right? I mean, if you can get 5% on a 10-year, like, geez, there's a play there for some investors. So
the good news though for some of the funds is, as the public markets recover, they've recovered a lot the last couple of weeks, then people's overall dollars go up, and if you got a percentage allocated to private equity, it gets closer to where investors start to put money in private equity again. But these big pension funds, these big endowments that work on very serious ratios, we're only putting 13% into private equity. When the numerator or denominator goes down, there's trouble because they're not putting more money into private equity because they're above their weighted expectation or part of their portfolio is private equity. And so I guess the only good news is, on one hand, it makes the private equity returns not look as good when the market's going up. When the public market's going up, The flip side is when the public markets go up, it then provides, it gets closer to where endowments and pension funds are again committed to putting money into private equity.
That's such a great point, and it's been a while since we've talked about that denominator effect. But yeah, hopefully that can provide some cover for those large institutional investors to once again put more money into private equity. And frankly, that's certainly constrained some of the fundraising to date, right? We see funds not hit their targets. The so-called denominator effect that you just explained so well is definitely a contributor there. The other thing we keep pointing out and kind of alluded to earlier is that, there's a lag with monetary policy, not only in how monetary policy affects the real economy, but also even in the financial markets, right? We pay a lot of attention to the 2-10 spread and the treasury yield curve and all that. And that is affected fairly quickly, whenever Powell speaks, basically. But when it comes to the lending and credit environment for private equity buyouts, when it comes to portfolio management, there's a months-long to potentially up to year-plus long lag between some of those monetary policy decisions and how that works through the normal buying and selling of private equity.
Well, and that's really true. Just when you look at, like, people have been steering in this mountain of debt resets on the commercial real estate, and it takes a long time for the loans that were 5, 7, 8 years, 10 years, whatever they were, to start to come due. But they come due in a much higher interest rate environment, it makes it really challenging in the commercial office space and lots of other spaces. But there's a big lag from the time that it starts to hit different people based on when the loans are coming due or when the loans are up and have to be up. But no, your point is very well taken there. It really is. People have been talking about this daunting commercial real estate thing for years, and it almost feels sometimes like a frog boiling. At some point it will hit us, but it hasn't hit us as badly as expected yet, because it takes a while for these things to work themselves through the system. The other thing somebody alluded to is the best quote I've seen in a long time was one of the analysts said, Fed rate hikes are like shots, taking shots of tequila. You don't know you've had enough until you've had enough. And it's a lot of truth there. You don't really see the consequences until it's really significant. It takes a while for these to work through the economy.
Yeah, absolutely, yeah. And I think, and that's why I feel like they're being very diligent. The Federal Open Market Committee being very diligent, looking at the data, because they don't want to overindulge necessarily. But we've never been through this exact set of macroeconomic factors, right? So we're sort of it's like a shot of a liquor we've never had before, almost, in a way. I love that analogy.
100%. We try to be careful in the experimenting against alcohol. Exactly. In any event, Matt, always great to visit with Matt Wolf, brilliant leader at RSM, brilliant firm. Thank you so much for joining us today on the Becker Private Equity Podcast. Chanel, our producer, will be back with you a little bit later. Thank you very much for joining us.
Thank you.